Renovating Retirement with Charlie Jewett. Oh no, I think I'm about to have another episode.
Testing, 1, 2, 3. When's the best time to plant a tree? The best time to plant a tree was 15 years ago. The second best time is right now.
Oh, I just hate it when he includes his sound check. They're always so inappropriate, inoffensive.
Hello, people. Charlie Jewett from the Renovating Retirement Podcast, the Renovating Retirement Company, and the Renovating Retirement Movement. Maybe we can get mugs and t-shirts and make it the Renovating Retirement everything. Yes, and sometimes I include my sound check. Why? I don't know. There's no rhyme or reason. Some of my sound checks are fun, some are stupid, some are totally inappropriate, so I don't include those, usually. But today we're going to talk about a really important topic. It's episode 106 of the Sporadically Sporadic Renovating Retirement Podcast. I would be more regular if the rest of my life wasn't so crazy. Just crazy right now. I'm not even going to mention that. Whatevs. So, here it is, episode 106. This is on participation rates. Most people have never heard of a participation rate. I'd never heard of a participation rate before I got an insurance license and started studying the alternatives to the what's supposed to be tried and true, risk with a side of phase. It's jamming all your money in the stock market and crossing your fingers and hoping that that somehow is going to take care of a steady income until you both shall pass away and cover your spouse with enough income if you die and be available for emergency funds and be comfortable taking it. For instance, when the market crashes 30 or 40%, you really wouldn't want to take any money out for emergency funds or emergencies. Covering your sick life or your long-term care, all those medical expenses. Somehow this risk with a side of fees with mystery returns and a mystery balance is supposed to cover that. Really? Really? Not sure it will. Hope is not a financial plan. And then leaving money behind to loved ones. How are we going to cover that? What do we do? I know the answer to everything. Risk with a side of fees. When I came in without any biases, thank God, and said, well, why are stocks the answer to everything? Why is every single human being I've ever met, after 1,000 financial plans, why do all of them use the same exact financial plan, which is hire a joker broker, stick it into mutual funds, cross your fingers and hope for the best? Not because it's the best, because it's the best marketing. It's the most well-marketed. Is that good English? I don't know, because good English isn't even good English. Is it? Or is it well English? Is it English well? I'm going to dig a well and dump the English in it and dig it back out, and then it's good well English. I have no idea what I'm talking about. I don't know how to say it, but I don't know if that's what's best for you. Sticking all of your money inside of stocks, bonds, and mutual funds and just going, man, I hope it takes care of me, whether I have a long life, short life, rough life, sick life, and into the next life, baby. No. Why don't we just actually have a plan? Why don't you just have in-case income increase? 3 simple parts of money. Split your net worth into 3 very simple pieces. An emergency fund in case something happens. Should you stick it all in the bank and have it earn nothing for you? Of course not. I've taught multiple places on this podcast. I've got videos on it. You can get in touch with me, charlie@jewettwealth.com, CHARLIE @JEWETT wealth.com. I'll teach it to you live, or one of my people will. You don't have to use banks. You can use an insurance company. I've got people that have made, 23% over 2 years. And they're real compliance. These are real people. I can show you the statements, so don't choke on your fettuccine there, compliance guys. Put your pocket protectors away and push up those glasses and just calm down. Real returns on statements. Why? Because I'm a genius and everybody makes that money? No, because if you leave your money in the bank, it can't make money. It has no upside potential. There's nothing that can happen, even if the stars align. You can't make any money. There is no upside. Well, why don't we just put the money somewhere else with an insurance company where it can make money? There's some strategies that say, if the market goes up for 12 months, you get 1% a month. That's 12% upside. Oh, but Charlie, what happens if it goes down? It must be risky, because all we know is risk. All we know is risk. It must be risky. What if the market goes down? Well, in almost everything I've ever given to anybody, not because I'm an insurance guy, I carry all the licenses, but because insurance products beat everything the market has to offer, when the market goes down, you don't lose a penny. You just stay steady. 0 is our hero. Down years, don't make any money, but don't lose. Up years, make a ton of money, or fair returns at least. Where the bank is like, when the market goes down, you don't make anything. When the market goes up, you make almost nothing, a pathetic little pittance because we're making all the money. Why are you partnered with a bank? Why not just be partnered with an insurance company if they pay you 8, 10, 15, 20 times as much money when things go well? I'm so off track, I don't know what I'm even talking about. I'm about to put on a rabbit suit because I'm down a rabbit trail. Give me a carrot. My eyesight's getting better every day. Buck teeth and all. Don't know what I'm talking about. Back to the facts. Split your money up into 3 pieces: in case accounts, income accounts, and increase accounts. In case accounts just means have an emergency fund, 50 to 100 grand, whatever, enough to pay for your car and your roof if they broke at the same time, and get it working for you, which I can show you. The second piece is income. We don't do income with stocks, bonds, and mutual funds. They do a terrible job at it. Why would you want to live on mystery income for 30, 40 years of unemployment, which is what retirement is? That's silly. Just buy a paycheck, for heaven's sakes. Piggy banks, paychecks, and potential. Piggy banks, paychecks, and potential. In case, income, increase. These are the 3 types of money. And people say, no, don't buy a paycheck. That you're probably talking about an annuity, you fool. Annuities are terrible. Haven't you heard the billionaire online say, I hate annuities and you should too, and I'd rather go to hell than sell somebody an annuity? That's just because he's trying to get you to pay him money to risk it in the stock market. You didn't hear that. But you can say anything you want to about annuities, and I'm going to say, oh yeah, all those negatives are the same about your car. Wait, annuities might not be worth more money in the future than when you buy them. Yeah, neither is your car. Wait. Annuities might not go up in value. Yeah, neither is your car. But wait, we don't know what annuity is going to be. Neither is your car. But wait, annuity is a bad investment. Neither is your car. So is your car. But what if I want to leave a death benefit? Well, you wouldn't do that with a car either, so don't do that with an annuity. Do you own a car? Duh, yeah. Why do you own a car? Duh, because I like to get around and freedom and all that. Exactly. Why would you own a paycheck? Why would you own a guaranteed money tree? Why would you buy a steady paycheck that shows up like clockwork every single month of retirement until the day you stop working, until the day you die? Why would anybody value that? Maybe because that's what you had while you were working? Maybe because the definition of retirement is that your paycheck goes away? What do you replace a paycheck with? Risk with a side of fees? No, only if you listen to your joker broker and they sell you. Why not just replace a paycheck with a paycheck? Same. The happiest people you will ever meet are on pensions. The pensions their companies bought them were probably done through insurance companies where their company bought an annuity. Now, it's an inferior annuity. It's a single premium immediate annuity where they get income or they and their spouse get income, and there's no death benefit, there's no upside potential, there's no raises. When they die, their kids get nothing. You can buy the same pensions, but guess what? Newsflash. You can buy a better one. So you're actually better off not having a pension and having saved the money in IRAs or 401ks or just on your own or selling a house or whatever. You're better off with a big giant chunk of money where you go buy the Tesla, the BMW, the Mercedes of pensions, where yes, you and your family get the paycheck for the rest of your lives, but you also have upside potential. You also can have raises. If you pass away, your family gets to keep all of the money. Are cars good investments? Of course not. They're incredible lifestyle enhancers. That's why we all own them. Are annuities great investments if you're buying a paycheck annuity, an income annuity? No. There's nobody in their right mind in the country saying if you get a guaranteed paycheck at 5, 6, 7% of what you put in every single year for the rest of your life, that simultaneously your money is going to earn more than that and grow, and this is how you're going to leave money for loved ones or cover medical expenses. That would be stupid. No one is saying that. We're just saying, the good guys, screwdrivers are for screwing in screws, hammers are for hammering in nails, drills are for drilling holes. Do you understand? Blenders are for mixing drinks. Hey, why not use a non-construction analogy? What? People You set money aside for emergency funds, that's your in-case accounts. You buy a paycheck, that's your income accounts, usually annuities. Has nothing to do with being a good investment. That just means your advisor is undereducated or immoral or confused. The leftover money after you've set up your emergency fund and you have made a purchase, a bad investment. I hate when he says that. It makes me so confused. No, because life isn't about investing. Retirement planning is not about investing. It's about income replacement. Retirement means your income went away. Does not mean you need a giant chunk of money earning tons of rate of return. That's what the joker brokers tell you. If everybody in the United States got $10,000 a month the day they retired, that was just some weird country benefit we decided. As soon as you hit 65, you get $10,000 a month for the rest of your life. Very few people would be giving up the current lifestyle they could have and saving 5, 10, 15, 17% of their income to build some giant chunk of money that hopefully they would live off of, because it's always been about income. Don't get confused by the joker brokers. They're professional liars. They've honed their craft for 100, 200 years. They're very good at it, but it doesn't mean 2 + 2 is 5. They're still liars. 2 + 2 will always be 4. If you put me on the phone with any joker broker, they're going to last 3 to 5 minutes before they spaz out, freak out, hate me, hang up, or start huffing and puffing and going into a coma. They don't know what to do when I ask the right questions, or I can just teach you the questions to ask them. They will expose themselves as frauds within 3 to 5 minutes if you know what to ask. Do you guys beat the S&P 500? Can you show me how you calculate your rate of returns? What am I getting for these risks what am I getting for these fees and this risk? Do you understand annuities? How much training have you had in annuities? Can you explain annuities to me? They will hang themselves and disqualify themselves. By the way, folks, remember I've said this before? This is not about relationship. If you like your advisor, you're probably in trouble. I know some people like me, but some of the people that work with me don't like me. They just work with me because I'm the best. If you like your advisor, you might be in trouble. This is not a relationship. This isn't a marriage. You're not trying to pick somebody, one person out of the entire country or out of the entire world that you can experience the most joy and do the most good with by journeying life together. You're talking about a person that you only need to talk to once or twice a year at the maximum. You don't need to like your brain surgeon. You don't need to like your attorney. Probably better off with a jerk attorney that you hate. With your brain surgeon, you're under anesthesia. Why would you need to like them? But in this business, advisors are taught, get people to like you, and then they'll do business with you. If you can just give that up, if you can just say, I'm picking one person out of 7 billion human beings on the planet, and I need to pick the one person who most consistently and most clearly reveals the truth to me. The person who can be a windshield, the company who can be a windshield that lets me see so clearly that all of my decisions are easy. Hey, there's an old lady crossing the road. Should I speed up? Or should I stop, or should I swerve? You're all geniuses when it comes to that decision without an advisor. Nobody needs to be in the front seat screaming out instructions. Your eyes and your brain do the job for you. You go, there's an old woman crossing the road. I'm going to stop, or I'm going to swerve. There is no reason for you to be taking advice from advisors rather than taking charge of your own financial plan and seeing clearly. It may take listening to 100 episodes. It may take having the courage to email in and talk to us, Charlie@JewettWealth.com, CHARLIE @JEWETT Wealth.com, and saying, ooh, I don't know how it's going to go. He might be scary. He might try to sell me. No. Whoever you talk to on my team is going to be just like this. Just give you education. By the way, very few of you even know this. We've recorded every single strategy we use on videos. So we're not even going to be salesmen talking to you. We're just going to tell you which videos to watch. Okay, we're going to go, where's your money? What are you trying to accomplish? You don't have to like us. We don't have to be in your backyard. Virtual is fine. The world has changed. And where's your money and what do you want to accomplish? Just tells us which videos for you to watch as homework. You go watch the videos in the comfort of your own home, grab some popcorn, some wine, put your arm around your spouse, snuggle, do some kissing, do some watching, do some eating. And then we have a conversation afterwards, and all of a sudden, you're smarter than the broker you're currently working with because you haven't been trained by people who are trying to steer you into only one thing, which is mutual funds. This is a very easy industry. There's 4 or 5 tools, and 90% of the industry only uses one of them, mutual funds, stocks, bonds, mutual funds. All you have to do is go, well, let's learn the other 2 or 3, and you'll be a genius. You'll be smarter than any advisor in the country. Other than that, I don't have any strong opinions on the subject. Booyah! Anyway, what's this podcast about? Participation rates. Back to participation rates, okay? So you have your in-case accounts, your income accounts, and your increase accounts. You have your emergency fund, your income, and your growth. Participation rates are probably best understood just looking at it as a growth tool. It could be involved in your other accounts, but we're going to ignore that for now. Participation rates is a way of partnering, usually with an insurance company. It doesn't have to be, but a way of partnering with an insurance company to have gains, to grow your money, but without risk. And what do I mean by that? Let me just say almost everything that you're currently involved in, your participation rate is 100%. So nobody ever even talks about it. So if you go down to a Edward Morgan Lynch office and say, I want to open up a portfolio because I've heard that the only thing in the universe is stocks, bonds, and mutual funds. It's what my mom did. It's what my dad did. My brothers do. Everybody does. My neighbors do. Everybody. I'm a lemming. I have to follow the crowd. I want the same life as every other human on the planet. I want to be average. And you go into an office, say, give me a portfolio. By definition, besides the fact that through fees they're stealing from you, by definition, if you're in a portfolio and it's in, let's say you're just in the S&P 500, you'll never be just in the S&P 500. They're going to spread you all over the place to create the image that they're doing their job, when the reality is if they just put you in the S&P 500, you'd make more money than what they're doing. But they're going to spread you around through 30 or 40 different things. The reality is if that portfolio goes up 20% next year, ignore the fees they're taking from you. You get all of it. It's 100% participation rate. All the growth is yours. And that's fine. On the other side, if it goes down 30%, 40%, like we saw in 2008 and 9, if the market drops significantly, like we're due for now, you lose all of it. There's no protection on the downside. There's no limit on the upside. And for very good reason, that's why they say don't put any money in this type of strategy where you can afford to lose it. This is just for play money. Although everyone who's come to me in 1,000 financial plans has all their money in this one account or this one strategy, which makes no sense to me. But everybody risks all their money here. All the money in the 401k, all the money in the TSP, all the money in the 403b, all the money in the IRAs, all the money in the non-qualified or after-tax brokerage accounts. It's just all in stocks, bonds, and mutual funds. That's 100% participation rate. All of the ups go to you. All of the downs come from you. I didn't even know this existed. What I'm about to say, I didn't even know it existed until I went and got an insurance license, spent about $40,000, $50,000 a year on training for the first 3 or 4 years, and still to this day, continue to go to training after training after training after training. I'll be in Nashville next week in another training. I was in Florida in January in a 6-day long training. I do this 3, 4, 5 times a year. This exists in the world, and you don't know that. I'll give you an example. You can buy an annuity that has a 50% participation rate. And you go, well, wait a minute. What does that mean? I'm only participating at 50%? Yeah, it's kind of like you own a business with a partner. Have you ever seen Shark Tank? If you look at Shark Tank and you think of any of the 4 people sitting on the panel, they're incredibly experienced business people, and you go, would I rather own a business on my own, not knowing what I'm doing, or would I rather partner with one of these guys? 50% of the profits goes to them, 50% of the profits goes to me, and they bring all their experience, their entire team, all their connections, all their money, all their marketing, and they grow the company. Well, 50% of 10 times bigger company is better than 100% of a company that's only 10th the size, right? Partnering is wonderful. We all do it in our personal lives for the most part. Journeying together with somebody is awesome. Many of us do it in our business lives. This is just doing it in your retirement life. It's bringing on a partner who's better at something than you. And I'm not talking about a joker broker who's going to steal money from you, whether they grow your account or lose money for you. If you partner with an insurance company and they say, yeah, when the market goes up, they're going to pick an index like S&P 500 is the most common. And when the market goes up 20%, you get half of it. You get 10%. But when the market goes down, you don't ever lose a penny. None of the losses, half of the gains, versus all of the losses, all of the gains. Now, you may not know this, what the difference is, but I went back from the year 2000 to 2016. I'm happy to show you the research. I think it's on my Instagram page at charlie.jewett, whatever that means. You type Instagram space charlie.jewett and do a search on Google. You'll find my Instagram page. You'll actually see the research I did. It's in a colorful spreadsheet. If you put money in the S&P 500 in 2000, put in 500 grand, and then you put $500,000 in a 50% participation rate annuity with no fees, 0 fees, you would end up with 38% more money in the safer risk, the safer product, the annuity, than in the market. So how do you use participation rates, or how do you understand them? Folks, very simply, all of everything, all the losses and all the gains, just being in the Wild West, being crazy aggressive, doesn't necessarily mean you end up with more money. More risk does not equal more reward, period. More risk does not equal more reward. If anybody says that, they are a liar, or at best have not been paying attention since the year 2000 to the weather. The weather we're in now, the weather conditions we're in. Who cares about the weather in 1932? Does anybody check traffic reports from the 70s before you drive? No. I don't care what the stock market made over the last 210 years. I don't care what the stock market made while all the baby boomers were working from the 70s to the 2000s. I don't care about conditions in the market from decades ago, especially back to when we didn't have electricity. The only thing I care about, honestly, is the conditions of the market from now until you die. That's retirement planning. So what should we be looking at? 60 years ago? Or the last 10, 12, 15 years? Go back 16, 17 years. The stock market has failed and underperformed every safe investment that we offer at Renovating Retirement. So people are like, oh, you guys are insurance guys. You're just this. You're just annuity people. No. If you own a store for vegetarians, you don't stock it with meat. You pick a target market and you offer vegetables. Our target market is retirees and pre-retirees, people that need to have an income stream to pay their bills when their income stops. And they might need to pay medical expenses, and they want to leave some money to kids. And if they die, they want their spouse to be okay. In that target market, stocks, bonds, and mutual funds do, listen close, nothing for you. There's no worse tool on the planet for the retiree, except for maybe sticking your money under a mattress or all of it in the bank, than stocks, bonds, and mutual funds. They have underperformed annuities and life insurance. Now, can you find a crappy annuity or a crappy insurance agent to sell you a crappy life insurance product? Yes, you can. And there are stock market portfolios that will beat those crappy products. But why on earth would anybody design a crappy product? Well, I know why they do, because they work for the company as a captive agent. They're forced only to sell one company's crap. Why would an independent fiduciary like me, who spent 14 years honing his craft, being the best in the country, never being beat by anybody, give you one of those? We're not going to. We're going to give you the best of the best. I'll show you what I'm buying for me. People, stocks, bonds, and mutual funds have zero place in your life unless you need the drug of the adrenaline of the fear and greed going up and down as you make and lose money. Why do I say that? Because for retirees who need long life, short life, rough life, sick life, and the next life covered, annuities and life insurance do it better than any stock portfolio on the planet, unless you're George Soros or Carl Icahn or one of these rock stars that you don't have enough money to work with. Participation rates. Another example of that might be there's an insurance contract that doesn't pick the S&P 500. It picks, some, they call them, I don't remember what they call them. They're like exotic indexes or something like that. They're other little indexes. Everything moves when the market goes up and down, because indexes are all a measurement of some piece of the stocks and bonds that are in the stock market. So this company says you get 105%. Oh, surprise, surprise. This company's actually using S&P. Oh, nice. Forget everything I said about exotic whatevers. They're using the S&P 500, but they make you wait 2 years. So every 2 years you find out, did you make any money or not? If you'll do that, if you'll give them the patience of waiting every 2 years, which makes options cheaper for them, is what's really going on, they'll give you 105% of whatever the market did. Well, that's interesting. So if the market goes up 10%, you get 105% of it. If the market goes up 20%, you get 105%. You're getting more than the actual growth of the market. So more than all of the ups with none of the downs. And this is going to trigger your "that's too good to be true" meter. So go back and listen to my podcast on why what I teach sounds too good to be true. I'm going to wrap this up and make it really short. Or make sure it's not too long. Let's say that. Cut it short, right? Why not? A participation rate is profit sharing. It's splitting of revenues. If 10 grand comes in, you get 5, they get 5. Or some splitting. Right now, the best, and this won't, this podcasts are eternal, so when people listen to this in 20 years, this may not exist, but at the recording of this podcast, there's actually an annuity that says no risks. You don't lose any money when the market goes down. There's always the risk of the insurance company going out of business, which has never happened. So when you study that risk, they're safer than banks. They're safer than everywhere you have your money now. So yes, we can't say there's no risk, but we can say there's less risk than what you're doing now. There's actually an annuity out there where they say we're not going to charge any fees. We'll give you all your money back if you need it in 5 years. 5 years is really short to be able to get all your money back in annuity. So there's high liquidity. Plus you can take 10% a year or whatever. When the market goes up, you get half of it based on the S&P 500. You get half of it plus the dividends. There's no other annuity on the planet paying dividends on these annual point-to-point kind of S&P returns. Half of the market plus dividends, you're getting like 60, 70, 80% of what the market's doing. When the market goes down, you don't lose a penny and nobody's charging you any fees. So when you say, "Charlie, why don't you use stocks, bonds, mutual funds?" And I say, because they have crappy performance. They don't do anywhere near as well as the competitor. So why on earth would I ever risk $1 or pay someone a fee to go gamble for me when the safer competitors pay me more money? That's just good, sound financial decision making. If you want help with good, sound financial decision making, just send me an email, charlie@jewetwealth.com, CHARLIE @JEWETTwealth.com. Myself or one of my retirement renovators, we will take incredible care of you, not selling you products or jamming you into stupid portfolios that people above us want us to offer, because we're completely independent fiduciaries. Doing mortgage planning, estate planning, retirement planning, insurance planning, and tax planning blended into one plan, more comprehensive, more independent, more on your side, more honest as fiduciaries. All we're going to do is teach you things that make your decisions easy so you can have the best retirement plan on the planet. Get in touch, charlie@jewetwealth.com, CHARLIE @JEWETT. Other than that, I don't have anything else to say because I think you people are the best.
Renovating Retirement with Charlie Jewett.
That's all, folks.